Hey, good afternoon, everyone. Marty Missouri here, Friday, 25th of November, 2022, with a brief look at the economy and then a brief stock market technical snapshot. In front of you is the graph of our PWA index. And folks, we just hit the lowest level that we've hit since we moved back into recessionary conditions. So clearly, our view is that recession odds are notably higher than continued expansion odds going forward. Per my morning note this morning, we still maintain that we're looking at a mild recession by historical standards for reasons that I've pointed out here previously and then expressed again via a quote from a Wall Street Journal article this morning. So take a look at that if you haven't already. Our handful of inputs that I chose to share with you this morning from the 45 total inputs that contribute to our index. We'll start with retail sales. Now, the primary retail sales data has already come out, but we also track the Johnson Red Book, which comes out weekly. And as you can see that despite the season we're in, it continues to drop on a rate of change basis. Mortgage purchase applications actually ticked up a little bit. We're down below 7%. I believe it was 6.6% roughly is where the average 30-year fixed mortgage rate is, down from 6.9% last week. So we got a little tick here higher in the mortgage purchase apps, which of course is welcome. Consumer confidence, however, continues to go down. This was the latest University of Michigan read at 56.8. Just looking at the summary language from the report, along with ongoing impact of inflation, consumer attitudes have also been weighed down by rising borrowing costs, declining asset values, and weakening labor market expectations. For the sixth straight month, over 40% of consumers reported that their living standards are being eroded by inflation, with few differences across the income distribution. Hence the challenge for the Federal Reserve. I can tell you folks, the factors that are weighing on our proprietary index are also the factors that have kind of been bolstering the stock market of late, along with real positive seasonality. And that is, if the economy is indeed weakening, well, then inflation should continue to soften. And most importantly, it should have the Fed easing off of their tightening pedal. And the Fed rhetoric lately, I think on balance or at the margin, has been supporting that language. While they do say that the market has it wrong if it thinks that they're going to be cutting mid-year next year, which is what is priced into Fed funds futures. And they do tell us that they're going to go slower, meaning 75 basis point move December 14th looks like it's entirely off the table. A 50 basis point move is what is clearly priced in. That's absolutely what they expect to do, at least at this juncture. And then another, I believe, another 50 basis points, and then 25 basis points, and then stopping thereafter. So a pause seems to be in the market, but not a cut. So we'll see, and I think it all depends on data and conditions as we move forward. And the conundrum, of course, is that you could have a slowing economy with yet stubbornly high inflation, and that still is the consumer's number one concern, is this inflation. So the pressure is still on the Fed to continue to focus on their inflation mandates, but you can tell certainly by their rhetoric since the UK near blow up, and I've been referencing that a lot, and they actually did reference that in their minutes from the last meeting that were released last week. So that really got their attention in terms of being a little bit careful here going forward. So anyway, it's going to be interesting to see as these things continue to unfold. And more evidence of the challenge is that amid still relatively high inflation, albeit softening of late, suddenly we got another spike in jobless claims, weekly jobless claims this past week, as well as continuing claims. So again, this is the kind of stuff, ironically, or maybe counterintuitively, the stock market seems to like right now. But I can assure you that it's not going to like it if indeed it does the obligatory number on corporate earnings at the same time. And that's that next leg down in the bear market thesis we keep talking about. Truck tonnage rolled over here this last month, as you can see, so that would be another negative score in our index. Rate of change minus 2.3. The Chicago Fed National Activity Index, an important and widely followed measure of economic activity, dropped back below zero just barely here this last month. And you can see it really dances along that zero line. So what we look for is we look for the big trends. So if we have a downward sloping move, that's where we begin getting concerned about the potential for recession. And you can see we've got that going on here currently. Another very telling indicator, an important one, is the ratio between consumer staple stocks and consumer discretionary stocks. And as you can see, for the year, that has been a pretty consistent uptrend. Definitely some volatility. We actually improved our score here. We had a sharp downturn, and I showed you that not only here, but in other sectors relative to the S&P. But we seem to be getting right back to that uptrend. You can see that staples now are only down a little over 1% on the year, while consumer discretionary stocks are down more than 30% on the year. So why is that important from an economic indicator perspective? Well, staples is stuff that you got to buy if you want to keep breathing, right? Food, etc. Whereas discretionary items are things you buy when you have extra income. So while retail sales are decent, what the market is telling you is, to the extent that consumers are spending money, the market anticipates they're just going to be spending a lot of money on staples and less on discretionary items. So that wraps up the handful of indicators. And as we always do, crunching the data as we go, being as quantitative as we can, and then kind of thinking about what we've just experienced. A while back, I wrote a pretty thorough essay on the bullwhip effect. If you missed that one, just shoot me an email and I'll send you a link to it. And what that means in terms of the prospects for the economy, retail sales, et cetera, going forward. Nick and I were discussing this morning. So, we saw COVID happen. We saw the huge ramp up in goods purchasing. Consumers who lost their jobs got a ton of stimulus through increased unemployment and stimulus checks that they spent on goods while they were locked up. Now they're set free, let loose. They are out there. Bars and restaurant numbers are really ticking up. Our college student daughter works at a local restaurant, and she just couldn't believe the crowd that was there Wednesday evening. So clearly people are getting out and about. Now, what Nick and I were talking about is that phenomenon. So people bought all the stuff they're going to buy for quite some time, and we've got a huge pull forward of purchases, and we're seeing that in the goods-related data, the real fall-off sort of recessionary conditions there. And now you have the big rush to services. So as people kind of get that out of their system, it'll be very interesting to see, number one, if they get it out of their system. Presumably they will, as you see this huge ramp up in credit card usage here of late. Coincident with that is the big reduction in the savings rate. So people are dis-saving and starting to use revolving credit again. So these are the same consumers, or the children of the consumers, who went through the massive disruption of the 2008 worst recession since the Great Depression, where consumers were way out over their skis with debt and then delevered for the following decade. I wonder if that mentality won't come back a little sooner this time. You know that our base thesis that it's going to be a mild recession somewhat depends on the relative financial health of the consumer, despite the fact that they're ramping up their credit card usage. From a balance sheet perspective, they still look quite good. So we're not talking about just massive unserviceable debt at this point, but we are talking about massive increases as they get out there and spend. So if we get through the Christmas season and we see the consumer begin to maybe start thinking a little more conservatively about how they spend their money, and they're already, chock full of all the goods they're going to purchase for a while, that really supports this rolling into recession early in the year, which right now is what we anticipate. But again, as I've said before, with that, you will see a come down of interest rates. So as it relates to equity markets, while the recession and the lower corporate earnings that come with that negatively impact stock prices, they're also going to have the somewhat buffer or tailwind of falling interest rates there for a while. Okay, so let's just do a quick one on the S&P. Could probably even skip this because of the nature of the trading here this last week, holiday week, lack of volume and so forth. But we'll start with the weekly chart. Weekly chart still looks very constructive to me. Again, we broke out decisively from this falling wedge pattern, broke through the 20-week moving average, and closed this week just above the 38% retracement. Going to run into some huge resistance if we keep going up here at around 41.50, and that is the downtrend line, the 50-week moving average, and the 50% retracement of the bear market. That's going to be a tough thing to overcome. And if we're right about our general thesis, the market ultimately will not overcome that and will turn back down and will at a minimum test our lower target here, 3,500. On the daily chart, I showed you Tuesday the on-balance volume data that says it looks like as the market's going higher, that we see more conviction on the down days, which would be distribution, taking advantage of the rallies to get out of Dodge, so to speak. But when we look at the momentum indicators, there's nothing about the MACD here that's bearish just yet, other than the histogram says we may be getting there soon. And but just the slope of the MACD and the RSI, these aren't bearish divergences. It is an ascending triangle at a minimum. Could break through there. We have the 200-day moving average and then the downtrend line. My base case is that I said that's in the cards, but a couple things. I don't expect we get out of this into the next bull market before at a minimum we fill that gap from a couple Thursdays ago, but truly actually until at a minimum we test that 3,500. And if we actually do see recession, we're going to have to come up with a lower target before this is all said and done. And then lastly, the hourly chart. So again, showed you this already. We broke out of that falling wedge. This looked a lot more ominous than it actually turned out to be. Found support right there at 3,900 and stayed, again, solidly above 3,950 and is looking right, just basically dancing right on the line here. Right, that is this high going back to early September, right? That we gapped through, but then fell apart here mid-September, and then we had this, this pretty severe downtrend. Found support here at 36.15, ultimately right at our 3,500 mark down here. And then have been kind of battling back and forth. The indicators have worked really well in terms of giving us indications of where the peaks are and the valleys and so on. So right now we're just bouncing down against this support right here. Call it 40.20. But as you can see, the MACD is just about to roll over. Just finished today with a sell signal. And again, this is just the hourly chart. This is very subject to change, high frequency stuff. And definitely a bearish divergence here on the RSI. So this would tell us to kind of look out below going into next week. But, this is pretty impressive, the fact that it was able to hold up. But, keeping in mind, good seasonality, low volume, so it doesn't mean a lot until we get all the traders back to work. And then relatively poor economic data, which softens the Fed's case a bit. And as I've expressed, that the market likes based on how it's been trading and based on where we are at the moment. Again, I can't emphasize enough that if this data continues to play out, then we're talking recession, and then we're talking stock prices having to discount poorer earnings. All remains to be seen. We're open to all possibilities, including a bull case if this continues to ramp higher, and we'll make that case once we believe in it. But right now, in the near term, lots of volatility once we get into early December, and between then and December 16th, options expiration, which is the biggest one for the year. And a lot depends on how that plays out and the positioning going into that to determine if we're going to rally through Christmas or if we're going to get back some of that big Q4 rally that we've enjoyed so far. Folks, I will leave it there. Hope you have the best of weekends and talk to you next week. Take care. Bye-bye.